Do you want to make another investment into real estate? Thinking about taking the jump into industrial outdoor storage or truck parking, but worried about the economy and what will happen in a worst case scenario? Watch this video as I describe 3 ways that I've used to minimize my downside risk when making my own commercial investment. Ron from Rohde Law. I'm a commercial real estate lawyer and industrial direct investor here in DFW. I own 7 properties, but I came from a residential background. I had 6 SFR, single family residential houses. They were a pain to manage. It was good cash flow, but I came from this and I made a transition to commercial, but I was scared. And these were my top things. I didn't want to have to service the debt. This was a big mortgage payment every month. I didn't want to lose the property to foreclosure. This is what kept me up at night, and these are the top 3 things I did to help me overcome those fears. The first building that I ever bought was a 37,000 square foot building. It had a single tenant and a triple net lease. There were a lot of risks associated with that, including a $14,000 a month debt payment. Now, I knew that it was difficult to service that by myself, including property taxes and insurance if the tenant ever vacated. But how did I overcome that risk and make that first commitment? Let's talk about the 3 areas that I consciously evaluated before I pulled the trigger and put my money into that property. Number 1. Lease structure. I talk about triple net leases all the time, but they are an excellent tool to mitigating your downside risk. In this scenario, the triple net lease, the tenant reimburses the landlord for property taxes, insurance, operating expenses, everything else that the landowner doesn't have control over, the tenant reimburses you. And so what that means is for the duration of your lease, let's say you sign a 3-year, a 5-year, 10-year lease, for that duration, the landlord does not have to worry about yearly changes in property taxes. Insurance premiums don't affect your return. The tenant just has to pay. Now, that doesn't come for free. That limits your downside risk, but it also caps your upside. And I think people don't talk about this enough, but a triple net lease does cap your upside. If market rent doubles from year 2 to year 3, the landlord, you're unable to capture any of that value. You're sitting on your hands, you are tied by that lease, and you can't capture any of that upside market rent. What I recommend, triple net is complicated. Read, reread, and really understand that lease before you buy a building with a triple net lease. The number 2 way to mitigate your downside risk is with multiple tenants. So this is more common in smaller buildings. You may see them, we call them flex buildings, office warehouse. These typically have suite sizes between 1,500 to 2,500 square feet, and it has multiple tenants. You may have 2, 3, 4, 5 tenants in a single building. But this is a great way to mitigate your downside risk. If you were in a recession, if the economy stumbles, who knows what's going to happen with Trump? 1 or 2 tenants leaving doesn't negatively impact your cash flow. You can still service your debt, you can pay your property taxes on the vacant units, but you will not lose money, and you don't have to reach into your own pocket to pay expenses on a multi-tenant building if a couple of tenants leave. Again, you can calculate what your break even is, but I guarantee you're going to be in a better position collecting 40% of your revenue instead of a single tenant vacating and collecting 0. Number 3, the best way to mitigate recession is to do a deep dive into your tenant's business. Now, what I mean is when you're coming from residential, all people are kind of the same. They want to pay their rent, they have some type of job, but you largely don't know what their job is per se. In industrial and commercial, you get a deep dive into the tenant's business. And there are some industries that are more recession-proof or recession-resistant than others. And what I mean is, for example, if you have a tenant in an industrial building that's a road construction company, okay, they're building these multi-hundred-million-dollar contracts with state, federal, local municipalities are hiring them on multi-year contracts to build this road. As a tenant with a source of income, they are more stable than another type of industry. For example, a car wrap business. People that put the fancy matte blue car wraps, window tinting, that is not a great industry that if we're in a recession, the first thing people do is they cut discretionary spending. They're not going to go pay to have their car wrapped in a new color when we're in a recession. Road construction, good. Car wraps, bad. And so if you do a deep dive, you might not be getting top of the market rents for this road construction business, but you get the assurances that even in a recession, most governments pay their bills. So another great concern, and this kind of piggybacks onto the tenants industry, which is liability. I do know some people that worry about their building going up in flames or some huge explosion taking their landlord down with them. And that's a valid concern, because not only if it is a risky operational business, your premiums are going to go up as well as a function. However, doing a deep dive into what are the triggers on your insurance policy that trigger an increase in premiums, that will help you avoid that. And I'll just go off the bat. A lot of the risky uses involve high rack heights, pile heights of flammable materials. And there's a difference. Again, I'm using a lot of technical words, but if they are stacking flammable fabrics or foam type materials, those are highly flammable, versus if they're stacking metal car parts. If they're stacking wheels all the way to the ceiling, those aren't flammable. We're not worried about the cardboard boxes going up in flames because there's not a lot of mass there. And so choosing tenants that have a low risk profile for their activity is going to be better. We don't want to see propane and propane accessories, huge liability for an explosion. Chemicals. Are they storing chemicals? We just did a lease for a tenant that was a pool cleaning company, and they stored massive amounts of hazardous materials. These hazardous materials do cause an increase in insurance premiums. All right, I'll do my conclusion before the battery dies. So that's it. Look, investing in real estate, it requires some risk. The returns here are fantastic, and you can't avoid it, but you can mitigate your risk. So I hope these 3 tips were useful. If you're still watching this video, smash that like button, save my throat before I die. Have a great trip, and we'll see you next time.